Your friend with the $65,000 SUV is not secretly rich. She is on an 84-month loan she will still be paying off after her toddler gets a learner's permit. And she is not alone. The average new car payment in this country just hit a record high. And nearly 1 in 5 people financing a car right now are paying over $1,000 a month for it. Somehow, the lot is still full on a Saturday. I used to think everyone around me had cracked some financial code I hadn't found yet. Turns out, a lot of them just signed for a longer loan and called it a win. There is a very specific trap happening in car financing right now, and it is not really about the car. It is about the math nobody shows you before you sign. Here is the part they don't need to hide, because it is just math. Your monthly car payment comes from 3 things: the price of the car, the interest rate you are charged, and the term, meaning how many months you are paying it off over. Move any one of those, and the payment moves with it. Think of the loan like a pizza. The whole pie is the price of the car plus every dollar of interest you will pay over the life of the loan. The term is how many slices you cut that pie into. Cut it into more slices, and each individual slice looks smaller, but you are still eating the whole pizza. You are just eating it slower, and by the time you get to slice 50, it has gone stale in the box. That is the entire trick behind the modern car payment. Dealers know the number you are watching is the monthly figure, not the total you are agreeing to pay. So when a car gets too expensive to fit your budget at a normal loan length, the industry doesn't lower the price. It stretches the term until the monthly number looks survivable again. On paper, it works, your payment fits, you drive off the lot, but you have just agreed to be in debt on a depreciating asset for longer than most people keep their car. And that gap is where the actual trap lives. Quick napkin math so you can see it for yourself. Finance $30,000 over 60 months, and you're looking at a payment somewhere around $580, give or take your rate. Stretch that exact same $30,000 to 84 months, and the payment drops to somewhere around the low 400s. Looks like a win, except you'll have paid several $1,000s more in interest by the time you're done on a car that's already had its transmission serviced by month 70. Here is what that looks like in the current market. The average auto loan financed on a new car right now sits at just under $44,000. Interest rates on new cars are averaging around 6.5%. Used cars are worse, averaging over 11%, because used car loans always carry more risk for the lender. But that average hides a lot. Where you land on the credit score chart decides whether this whole conversation is mildly annoying or genuinely dangerous. Someone with excellent credit is financing a new car around 4.5% right now. Someone with a bruised credit history is paying north of 16% on the exact same model from the exact same lot. Same steel, same tires, wildly different bill every month for the next several years. So car prices climbed, rates climbed with them, and the industry did what it always does when affordability breaks. It didn't lower the price, it stretched the loan. Almost a quarter of new car loans right now run 84 months or longer. That is up from roughly 1 in 14 loans back in 2019. They market it as a payment you can live with. And here's the part that should bother you more than the rate does. Those longer loans aren't even cheaper in the long run. Someone financing over 84 months is paying a meaningfully higher interest rate than someone financing the same car over 60 months. You are not just paying interest for longer, you are paying a higher rate to do it. I refinanced a car once in my 20s because I panicked about a payment I never should have agreed to in the first place. Sat in that finance office, heard a number that felt fine, and signed without asking a single question about the rate. Learned the hard way that a lower monthly number is not the same thing as a better deal. It just means someone moved the pain further down the road and hoped I wouldn't notice. That is where we are right now, industry-wide. Payments stretched thin enough to feel normal, on loans long enough that a meaningful chunk of drivers will still owe money on a car that is falling apart underneath them. Here's where the math stops being an abstraction and starts costing people real money. Right now, close to a third of people trading in a car owe more on it than it is actually worth. On average, that gap is over $7,000. That number does not disappear when you trade the car in. It gets rolled into the loan on your next car. So you walk into the dealership already $7,000 behind before you have even picked out your next vehicle. And the easiest way to make that new, bigger loan feel affordable is, of course, to stretch the term even further. That is not a coincidence. Nearly half of new car purchases involving negative equity right now are financed with those same 84-month loans. It is the trap feeding itself. Long loan creates negative equity. Negative equity gets rolled into the next long loan. Repeat. And this isn't a small side effect happening to a handful of unlucky people. Auto loan delinquencies, meaning payments at least 90 days late, just passed the peak they hit during the 2010 financial crisis. For borrowers with weaker credit specifically, missed payments just hit their highest level in over 30 years. I want to be really clear about something here, because finance content aimed at women loves to make this about personal failure. And it is not that. This isn't a story about people being reckless with money. It's what happens when a payment gets engineered to feel manageable in the moment. And nobody says the 7-year math out loud before you sign. You didn't do the math wrong. The math was never shown to you in the first place. And I'll say this too because it matters. Women get steered toward the just focus on the payment conversation more than most, whether that's a dealer assuming you don't want to talk rates or just genuinely not having anyone walk you through it before your first car purchase. That's not a character flaw. That's a gap in what we were taught, and it's exactly the kind of gap this channel exists to close. So let's fix it, starting with who actually benefits from you never seeing the real number. It's the finance office you get walked into after you've already picked out the car, already pictured yourself driving it home, already told your group chat. And the person in that room has one job: not to find you the best deal, to find a monthly number you'll say yes to.
This is where payment packing happens.
Extended warranties, paint protection, gap insurance, service plans, all quietly folded into the loan instead of your monthly payment, so the increase feels invisible. An extra $60 a month sounds like nothing. Multiply it by 84 months and you financed a small vacation's worth of add-ons you may not have even wanted. Then there are the incentives. 0% financing, cashback offers, the ones plastered across every commercial. Those offers are real, but they are usually only available on specific trims, specific terms, and specific credit tiers. And dealers know most shoppers won't ask enough questions to find out they don't qualify for the version being advertised. You walk in chasing a 0% headline and walk out with a rate that's anything but. And manufacturers benefit from all of this too. A stretched out loan means a higher total transaction price gets approved because the sticker shock disappears into a payment instead. Nobody in that chain, not the dealer, not the lender, not the manufacturer, is incentivized to hand you a shorter loan or a smaller number. Their business model runs on you focusing on the monthly figure and nothing else. I'm not saying dealerships are villains twirling a mustache in the back office. I'm saying the entire structure of that conversation is built to keep your eyes on one number, while the number that actually determines whether this was a good decision, the total cost, sits quietly out of frame the whole time. Okay, here's what we're actually doing about it, because knowing the trap exists doesn't help you if you don't know how to walk around it. First, ask for the out-the-door price and the APR before you talk about the monthly payment at all. Say it exactly like that. So, that single sentence takes the conversation out of their playbook and puts it in yours. Second, get pre-approved through your own bank or credit union before you ever set foot on a lot. This does two things. It gives you a real benchmark to negotiate against, and it means the dealership has to beat your rate instead of just naming one and hoping you don't compare. Credit unions especially tend to run well below dealer financing. Third, match your loan term to how long you actually plan to keep the car. If you trade every 3 to 4 years, an 84-month loan is basically guaranteeing you'll be underwater every single time you trade. A shorter term costs more per month, but it gets you to actual ownership, and ownership is what breaks the cycle. Fourth, refinance once your credit improves. If you took a loan at a higher rate and your score has climbed 6 months or a year in, shop that loan around the same way you'd shop a mortgage. Credit unions in particular will often beat what you signed for at the dealership, and refinancing costs you nothing but a little paperwork. Fifth, know your trade-in value before you walk in and negotiate it as a completely separate transaction from the new car price. Dealers love blending the two numbers together because it hides where the markup actually is. Look up your car's value yourself first, get that number in writing, and don't let the two deals get mixed into one conversation. And if you are financing a long-term or high loan-to-value ratio, look into gap insurance. It is inexpensive, and it is the difference between being fully covered and being stuck paying off a car that no longer exists if it's totaled while you're still underwater on it. And one more, the free one. If a payment doesn't feel right in the moment, you're allowed to just leave. Tell them you're sleeping on it. A dealership that pressures you to sign the same day you walked in is telling you exactly how confident they are that the deal won't survive you doing the math at home. Let them not survive it. None of this requires you to have flawless credit or cash on hand. It requires you to ask better questions before you sign anything, in a room that is specifically designed to make you stop asking questions. So back to your friend in the SUV. Maybe she knew exactly what she signed up for and made peace with it. Maybe she didn't, and she's got 4 more years of payments to think about it. Either way, that's not really the point. The point is that the number on the sticker was never really the number that mattered. The rate, the term, and what happens to your trade-in 3 years from now, that's the actual deal. The payment is just the part they let you see. You don't need to feel behind for not knowing this. Nobody hands you this math on purpose. That's kind of the whole business model. If this saved you from walking into the box unprepared, subscribe, because I've got a lot more of these industry tricks to walk you through, and you deserve to know them before you sign, not after.